Good macroeconomic data in the US has led to the stocks on Wall Street tanking. Now, this sounds counterintuitive, right? Let's decode why. Hi, you're watching News 9 Live and I am Suyash Maheshwari. Before we begin, hit the subscribe button to get more such insightful videos. Today, let's decode why good news on the economy has suddenly become bad news for the stock markets. After all, it contradicts what we have learned in the school and those boring economics classes. When the economy is doing well, the stock market should benefit, right? It's supposed to be a direct relationship, yet here we are. Let me tell you why with a small example. Imagine your parents telling you that if you top your class, they'll buy you a PS5. But once you do top the class and ask for the promised PS5, they say if you buy you a PlayStation now beta, how will you top the class again? Now this example shows how an achievement like strong economic data can actually lead to unexpected concerns. Just like your parents worrying you won't stay motivated if you get that PS5, strong economic data can make investors worry about inflation. And that can cause the stock market to drop even when the economy is doing well. Now let's bring it back to what's unfolding in the US. The US stock markets witnessed significant rally in late 2023 and early 2024, driven by expectations of rate cut from the US Federal Reserve as inflation slowly eased towards their long-term target of 2%. However, that has not really materialized yet. While inflation is gradually easing, it still remains above that 2% target. Simultaneously, the US economy is robust, boasting a thriving jobs market and buoyant consumer spending, which exacerbates inflationary pressures. In this backdrop, if the Fed does decide to cut interest rates, it would further stimulate economy but also fuel inflation. So, higher for longer interest rate narrative has now set in, which is against what the market was previously anticipating, and that is leading to a stock market correction. You see, the market often operates in one of two modes. It either moves in sync with the economy, reacting positively or negatively to data, or it decouples, like it's doing now, reacting negatively to positive developments and vice versa. Investors have been experiencing the latter mode for about a year now. Now, if you are wondering why this phenomenon has not been the case in India, unlike our Western counterparts, India finds itself in a Goldilocks sort of a situation. Everything is just right, neither too hot nor too cold. The economy is performing well and simultaneously inflation is also on a downward trend. This scenario offers our central bank, the Reserve Bank of India, some leeway to consider cutting interest rates. With the economy thriving and inflation easing, the RBI can employ monetary policy measures to stimulate further growth without risking an uptick in inflation. So for India, good news for the economy is still good news for the markets. However, for the US, the paradigm has shifted, where good news is now being interpreted as bad news by investors. Do you think RBI will be in a position to now initiate interest rate cuts ahead of the US Fed? Tell us in the comment section below. Thank you for watching.